seeing this? How are you, by the way?
I can't unsee that guy. I mean, what's going on there on the top of your head? You look like what's the guy from Taxi Driver? De Niro, your guy.
Yeah,
Remember that?
that's
Yeah,
right. That's
exactly.
exactly right.
Um, Listen, let's talk about it. I mean, markets are moving here, buddy. I mean, like, we had that like kind of vicious sort of rally off of the lows last week, and some of the like the underlying stock movements have just been crazy. Like
Crazy.
earlier, you and I were talking offline. Tesla, okay, just topped $1 trillion again. It's rallied 30% in a little more than a week. I mean, that's kind of insanity. I mean, it doesn't just make a whole heck of a lot of sense. And it doesn't lead me to believe when you have a 10% move higher in the S&P and you have a 30% move higher in in a stock that's now $1 trillion in the same time period, that things are particularly working well here.
I'm with you. I said it on Fast Money the other night. The fact that Alibaba, which is still, I think, a $300 billion company, give or take, moved 50
Yeah.
percent, 50% in the course of 4 or 5 trading days. The market's broken. All the mechanisms around the market is broken. You mentioned Tesla. I mean, that bottomed out at 700, now north of 1,000. I mean, it's a crazy move.
All right.
Nothing makes a lot of sense here, Dan Nathan, to me.
But here's the thing, guy. So how broken is it? If the story in the second half of 2021 was that large parts of the market were correcting, if not crashing, if you will, right? But we were making new highs, for the better part of Q4, largely powered by 10 stocks. That's what we have again. I mean, right now, if you consider everything that we know about what the Fed's doing with rates, what we know about supply chains, what we know about inflation, what we know about wages in general, what we know about deglobalization, the uncertainty around geopolitical sort of events, and the S&P 500 is down 6% on the year after being up 26% on the year, and the NASDAQ, given the hundreds of stocks that we know that are NASDAQ-E, I think I just quoted that, NASDAQ, or coined that, NASDAQ-E, are down 50%. And the Nasdaq's only down 10%. I mean, something is really wrong, or you and I just have it. We're just dead wrong.
Well, it's usually me that's dead wrong. I'll say this, and I'm going to attempt to answer that question. I think people that have fled the stock market historically in times like this rue that day. They're like, I can't believe I got out entirely. Look at these stocks. So instead of getting out of the market entirely, what I think is happening now is they're effectively panicking into fewer and fewer names. For example, I mean, look at the price action of Apple just today, but over the last week and a half. I mean, the rally has been significant on a tape that was great, obviously, last week. It's a little dicey today. So I think that's what's going on to answer your question. They want to remain in the market, and they're trying to find a refuge in fewer and fewer names. Now, we'll see how that plays out. I don't think it's going to play out particularly well, but right now I think that's what's going on.
All right. Well, you and I, let's just say this, okay? So are we just wrong? We talk about all these individual names. We put up lots of charts. We do a lot of fundamental analysis. We talk to analysts. We talk to strategists. We talk to people at the companies. We talk to investors at the company. Are we just doing it wrong? Are we wasting tons of time on single names? Is the name of the game to just buy the SPY and the QQQ and sit back and let it all work? And don't worry about being long a stock that could go down 50 or 60%, because you and I would agree, when the NASDAQ sold off 80% from its highs in 2000 to its lows in 2002, that's never happening. Again, right? We can agree on that. Like, that's never happening again. So are we wasting our time on all these single stocks?
I don't think
should
so
we just
at all.
fold
No,
it?
I don't think we're. Well, I mean, if we're wasting our time, then I can go on to do other things. Like I can start to break down Yankees position by position, which I know you don't want me to do. And I can talk about last night's Ranger game, which I guarantee you don't want me to do. So, no, I don't think we're wasting our time, because quite frankly, for a lot of people watching, whether they realize it or not, you've owned a lot of those stocks that have gone down 40, 50, 75% by virtue of the fact that some of these mutual funds that you're in or ETFs that you're in. So I think it's important to bring this to light. And are we wasting our time? No, because at a certain point, I think the broader market will act in kind, and we'll see. But it's also worth having a conversation, because having a conversation, to me, it helps people to ask the right questions and to look at things differently and to sort of get themselves up the learning curve that is markets and is investing, Dan Nathan.
No doubt about it. All right, let's hit a couple headlines here. Yesterday, Carl Icahn phoned into Scott Wapner's new show called The Overtime. So his show at noon is called Halftime. The show at 4 o'clock is called The Overtime. And it comes right up into Fast Money at 5. So is that double OT, guy?
Well, good point by you. I mean, maybe we should rebrand the show. The double overtime or the bunch of old dudes after overtime or something like that. I just sort of like keep it fast.
You know what? With you, when you're leading off at 5 o'clock, we can call it sudden death overtime because that's all the time.
It could happen anytime. And I hope you enjoy that because there will be a day. I mean, there's that old saying, live like you're going to die tomorrow because at a certain point you're going to be right. And in my case, obviously, my days become fewer and fewer. But please, if that brings you joy, please continue.
No, it doesn't. I love you to death. All right. So Carl Icahn said to Scott, and I thought this was kind of interesting. Just so you know, the last time Scott had interviewed Carl Icahn from the New York Stock Exchange was the day they got Carl and Bill Ackman on together. And they had that big fight, which was kind of cool back in the day. All right. So Carl's saying there could very likely be a recession or even worse, which I thought was really interesting. So let's talk about recessions. Let's talk about what it means for the markets. We know what the technical definition is 2 consecutive negative GDP quarters. And again, some last longer than others. The one that we had in 2020 was really short. Why? Because federal funds went to zero and they started, throwing hundreds of billions of dollars in monetary and then fiscal at it. So we had a very short recession. What's your take about what it means if you're an investor at home and you hear this billionaire investor, say, well, it could be a recession or worse. Does that make you run for the hills?
No, and it's interesting. I mean, we had Batnick on our podcast a few months ago. I mentioned him because he actually put something out, and I was fascinated by the piece. He talked about what causes a recession. Does market sell-off cause a recession or vice versa? I'm pretty convinced, by the way, a market sell-off causes a recession. We'll see. So does it get me running for the hills? No. And I don't think, we throw around recession like it's a bad word. I would submit it's an essential part of the business cycle, and the fact that we try to alchemy them out is what makes all these problems worse. So JP Morgan, I mean, good for them. By the way, that's the same JP Morgan that a week and a half ago when Alibaba was trading 75 that said these Chinese stocks are uninvestable. I mean, they literally rang the bell. So, you take everything with a grain of salt. I'll tell this about Carl Icahn. He basically said, there's going to be a rough landing. Inflation is a terrible thing. I don't think they being the Federal Reserve, can engineer a soft landing. And I'm with him 100%. I think more and more people are coming to that realization. And that's going to have, again, to use the word, deleterious effect on the broader market standing.
Well, yeah. So just to have a little tease, you and I just got done interviewing Gavin Baker. He is a crossover investor, spent 20 years really at Fidelity, and now he runs a treaties management. He's a genius investor, and you and I just talked about this with him. That's going to drop tomorrow on our On the Tape feed, so check that out.
Friday. It's going to drop on Friday.
Oh, that's right.
Nathan. Today is Wednesday, as I mentioned at the top, because, of course, Wednesday Addams, which one of my favorite characters in sitcom history. Back to you.
Yeah, well, no, but part of what we were talking about is kind of these cycles. To your point, is okay, they're trying to manage, to a soft landing after we've seen some behavior as far as in our economy that we haven't seen in decades, 40 years as it relates to inflation and the potential for some kind of wage spiral, that sort of thing. And again, trying to be, at least, appreciative of the fact that what we don't know, we don't know. But, at the end of the day, I just don't know how. And you and I talked about this. Let's just pull up this S&P 500 chart here. We'll look at the SPY here. I just don't know how the SPY down 6%, from that all-time high just a couple months ago, given everything that we know. And here's the most important thing, okay, is we've had Delta, we had Omicron, now we have Ukraine invasion here. All of this stuff is crippling S&P 500 growth. And right now, I think consensus is still calling for 8 or 9% year-over-year EPS growth. That's just not happening, guy, right? And you think about what margins are going to look like given the inflationary pressures. You look at this chart, you see that rally. We didn't make a new low from February. What is the SPY chart telling you? And I'll tell you another thing. Amanda Diaz, our producer, she must have Carter Braxton Worth on the brain because that's a 150-day moving average that the SPY stopped at yesterday.
And I was going to say exactly that. We're paying homage, a silent H there, to Carter Braxton Worth using the 150. He thinks that's the important one. I happen to agree with him, and it really illustrates exactly this point. I mean, the 150-day was effectively a trend line from the lower left to the upper right until obviously the end of last year, beginning of this year. And then things got a little bit dicey. Well, we broke through it, traded back above it, broke down again. Now here we are touching it. I would submit we're going to break down one more time. I think this is a really important chart. And oh, by the way, that 150-day, which had been going again lower left, upper right, is now headed flat to slightly lower. I think there's a change in trend. I will say for the 30th time at least, and if I'm wrong, I'll be the first to admit it. I think 3750 is the ultimate target of this S&P 500. We'll see what happens if and when we get there. 4,000 being the logical stop first, to your point about that lower horizontal line that you drew. So I'm with you on this. So listen, the last week caught me off guard without question. I didn't think we would see a rally like that. Now things seem to be turning back, and we'll see. I think people are far too euphoric. I think somehow they think the situation Russia-Ukraine is going to resolve itself magically. I don't think it will. And to your point exactly, Dan, what's the right multiple when earnings are going the wrong way and when interest rates are going higher? I don't think it's currently where we are. And again, if those earnings disappoint, that just drags everything down with it, Dan Nathan.
Yeah, no doubt about it. I mean, listen, I'm in your camp. I just don't like to see moves like that off of a low. And I think the other point is, listen, some technicians will tell you the fact that in March we did not make a new low from February after February made a new low from January. That's kind of bullish here. But again, I think as we get into quarter end, we're going to start kind of thinking about what Q1 reports look like and what Q2 guidance looks like. And, Nike was kind of interesting to me 2 days ago when they reported. It was pretty good. The stock gapped up 6-7%, and then it closed on the lows yesterday. So that might be kind of a tell. And we'll talk about Adobe in a second here, but let's just say, okay, how can we be wrong about the market? With the S&P that's only down 6%, it can be unchanged pretty quickly. How would that happen? Well, you could get a bunch of crap to start to rally here a little bit. That if you had energy hold in there, you saw financials kind of firm up and make their way back. But if you had those top 6 stocks, like Apple acts amazingly well. It's gone from 152 to 172 in a week, right, guys? So if you had that, Microsoft, Google, Amazon, they could lead the way again, couldn't they?
No question about it. And I think a lot of the questions we get are exactly about names like that. They could. And look, let's look at the next chart just to take a look, just to eyeball it. I mean, the S&P chart tells you one story. This actually, the QQQs, triple Qs as they say, looks a lot worse. I mean, this you've had meaningful breakdowns. You never had a validation of the S&P high late in December. I mean, it doesn't really line up that well. And oh, by the way, that 150-day moving average, again, that was an uptrend line. Not only is it flattening out, it's actually trending lower. So I think there's definitely another leg lower. And I've said a number of times this as well, and I believe it. I think the broader markets will bottom when Apple trades down to about 137.5, 138, which if you go way back in time was a prior all-time high. Prior resistance becomes support. I think both the broader market and Apple will find it in that form, Dan Nathan.
Yeah, I agree. And, listen, the QQQ, people ask me, what do you want to leg into when you think we have bottomed? I think you go into the QQQ because the very point I was just making, those top 6 names or so make up, 45, 50% of the QQQ. And then you have all that other stuff in there, all that crap that's down 70, 80% or so. And those should help off of a bottom. So to me, the NASDAQ did make, or the QQQ did make a brief new low here. Let's see if it goes back. I think that 340 level or so could be some pretty decent near-term technical resistance. But Guy, Nostradami, I got to ask you this, because you had the call on the 10-year U.S. Treasury yield. That's obviously been a source of volatility as it relates to equities. And we know that, a lot of equity investors price a lot of risk that they're willing to take off of what interest rates are doing here. So here we are. We have the 10-year U.S. Treasury yield at 235. It was at 165, as you mentioned the other day on Market Call just a few weeks ago here. What would happen if yields came in? And Carter, just you were, I don't know what the heck, you had like a lunch or something yesterday, a liquid lunch. You couldn't join us here. But Carter said something about he thinks the potential for a pullback in yields. What would that mean for stocks? Do you think it would be bullish for stocks?
No, because I think if yields were to go lower, they would be because you're having a flight to quality in the form of bonds. In other words, people run into the bond market pushing yields lower, which probably by definition means the market is headed down. So no, I don't think it would be particularly bullish. I think it would actually be, that in and of itself would be bearish, and it would be happening for bearish things in the broader market. I'll say this, if you didn't know what this chart was, and you looked at it, you'd say, oh my God, this must be some $150 million biotech stock that just had a favorable phase 3 ruling or something like that. No, No, you'd be RONG wrong. And I think one of the mandates of those geniuses that comprise the Federal Reserve, I don't know, I read it in a book or something, is price stability. You got anything but stable prices. And listen, you say, Guy, you're a jerk. Yeah, I am a jerk. I think you spell that with a J. But I'll say this. Look at this chart. 10-year yields were 165. We're still in the month of March. Early in March, they were 165. They're now 240. You think that's price stability? The bond market is broken. So to answer your question, if yields go lower, it's probably because the market is selling off and yields continue to go higher. It means we have an inflation problem. Neither one to me are particularly bullish, Dan.
All right, let's real quickly while we're in.
You like what I did there, by the way? I'm on fire today, man. My Rigo thing is just, I'm channeling my inner Riggins. By the way, University of Kansas, I believe. Back to you.
Oh, yeah? Taxi driver. I got you, dog.
No.
But let me ask you this. You talked about prices and things moving around. You know, one of the things I thought was really interesting is that bank stocks reacted very strongly yesterday. So JP Morgan at one point was up 3%. So was Bank of America. Wells Fargo was up 4%. They closed off their highs. And then today you're seeing, you know, a pretty proper give back. JP Morgan is struggling with this 140 level, or at least that's a level. To me, what do you make of this kind of intraday or day-to-day volatility in bank stocks? Because it seems pretty extreme. And then the other one, Guy, you got to weigh in on these home builders. Look at Toll Brothers down 30%, Lennar down 26%. These are massive. This is just on the year. Now, granted, they had a late year breakout last year, but some of these rate-sensitive stocks seem to be really moving around right now.
So I think it's all part of the same. Again, I'm not an economist, I say it all the time, but I think all those things you just mentioned are all part of some of the same pastiche or some of the same overall markets that we're looking at in terms of banks and home builders and rates going higher and those types of things. In terms of banks, I think the market is struggling with what's valuation, what's the right valuation. JP Morgan has slowed off considerably since its all-time high a couple months ago. Is it a level where we can get interested? What does the inverted yield curve mean? And oh, by the way, there are parts of the yield curve that are now inverted. What does that mean to banks? And, you know, what does credit worthiness look like going forward? And oh, by the way, there are people blowing up in the commodities world. Who has exposure to some of these commodity houses, and what does that mean? I don't think that story has played itself out yet. So I think a lot of people are trying to come to grips with it. In terms of home builders, did we just see as good as it gets over the last 5 years? And does raising rates mean these home builders are in for a rough sled? Or is it just an inventory problem that they're going to have 5 years of runway with? I think that's why the market is struggling with both those things, Dan. And I don't have the answers. I'll tell you this. I actually think there's another leg lower in the banks, and I think it's going to be for credit reasons that are going to start to rear their ugly head.
Yeah, so we had a question yesterday from Greg Armand. He is a follower of our content, so we appreciate all that. He asked us to look at some of the software names, Microsoft in particular, and this kind of goes back, Guy, a little bit to what you and I were talking about, is like how we could be wrong if the markets were to get back to unchanged despite everything that you think and you and I think are really bad for stocks right now, most notably the potential for stagflation in an environment that we've never really seen before in our careers. And, you know, let's take a look at Microsoft here, because again, this is like a $2.3 trillion market cap company. It trades at a multiple that, you know, it used to be considered very high for this company, but it's back to kind of being a growth company, right, guys? So, you know, expected to have double-digit EPS growth this year. Revenues expected to grow, you know, mid-teens. That is on a $200 billion number, but trading this year at 32 times, 11.5 times sales. Next year, 28 times and 10 times sales. Again, $2.2 trillion stock here. I would just say, given where the stock was just a few months ago, late last year, and where it is right now, I don't think enough damage has been done. The sentiment didn't get bad enough. I know it was down almost 20% from its highs, but look at the chart from the start of 2020. Look at that trend line from the lows of the pandemic. It is below that. And I know what you're going to say. It held that support like a boss until it didn't. You wouldn't say like a boss, but you're going to say that prior support is now what?
Resistance, and that's exactly right. So to answer your question, by the way, I think in Birdcage, I think that was the name of the movie.
Great movie, Gene Hackman,
and the woman that married Harrison Ford, if I'm not mistaken, at her own show, Ally McBeal.
Flockhart.
Exactly, and I think one of the characters was named Armand. I don't think you're the same one, but I just thought I'd bring it up. Great question. I think Dan is exactly right. I do think there's a potential to trade back up to that trend line and fail. Listen, nobody is impervious. When the market participants start looking at valuation, no stock is impervious to that. And I think that's exactly what we saw in terms of the Microsoft sell-off. And it's a unbelievable company. They've done crazy things under Satya Nadella. He has transformed that company in ways that I don't think anybody thought possible. But it doesn't mean the stock can't trade back down to sort of that 250 level, and then we'll reevaluate there. So if what I think is happening, I think Microsoft trades back to that uptrend line, fails, 250, buy it there. Into earnings, I think, in early May, if I'm not mistaken, Dan.
Yeah, so let's look at another one in the software space, and this is an interesting one. The Information, which is a tech rag that I read, they were talking about last week in an article how Salesforce is starting to trade like Oracle the way it did once they just started making every 2 years like these massive acquisitions, just become a big roll up. They know, they paid what $26-27 billion for Slack last year, and they're digesting that, and it's kind of been a drag, on their earnings here. This stock is trading, 45 times. Multiple sales and 6.5 times a $200 billion market cap company. Sales are still expected to grow 20% a year for the next few years, but profitability is not the sort of growth that you might, kind of want given the valuation here. You look at that chart. This goes back to the start of 2020. You see that massive kind of move that we had into last year, which, was not a great setup for 2022. If you thought that valuations were going to be compressed with raising rates here. What's your take on Salesforce? Because again, I want to give Benioff I want to give him the benefit of the Benioff of the doubt. You see what I did there? But this thing does not look particularly healthy right here.
I think what the market is telling you, to your point exactly, is they're worried he's going to overpay for something. And again, the integration of these things is critical. And if you overpay and you're wrong, you get punished. And I think, unfortunately, it's a great company, and it wasn't the stock's fault or the company's fault that the stock traded north of 300. I think it's just paying for it now. I do think there's a level where this makes sense. But again, it comes down to valuation. And are we on the other side of the growth mountain for a name like Salesforce? And the chances are we probably are. And you have to find out what valuation is right. The flip side of that coin, by the way, is a name like Oracle, which you can make a compelling case on valuation about, and it's actually traded really well since their earnings release. I want to say early last week or the week prior, I'm not sure. So what does this say to me? I think there's another leg lower, unfortunately, if you own Salesforce. Dan.
Yeah, that's a great point. So the article in the Information was talking about Oracle. When their organic growth topped out, they started making all those big acquisitions, and the stock really underperformed, right? Like for years. So it felt like a decade or so. And so that's, I think, what they're kind of getting at. All right, let's speak of
By the way, I know you should give me some, I know you don't think I pay attention. That was a pretty cogent breakdown of Salesforce and Oracle. Anyway, I'm just patting myself.
I mean, listen, paying attention. The cheapest thing you can do.
Amaze balls. Anyway, please.
All right, let's talk about Adobe, because right now.
Wait a second. I just wanted to. If you didn't watch Fast Money last night, go back and watch the tape, because Dan eviscerated me about this one. He wound up being right. Because I got to tell you something. I saw the quarter. I saw the guide. I said, look, the stock's off from $700. I think you can actually make a decent case on valuation. And Dan stopped me in my tracks.
Yeah, wait, hold on. Were you annoyed?
Because no, not at all. No, because you were right. What I said was, look, the stock was up 12 during the day. It's giving it back now. Yeah. Blah, blah, blah. But I thought it was okay.
No, in the moment, I was wondering if I was a little too hot, a little too aggressive. And because I don't want to do that to you.
No, I love that. I think that's good TV. It's important.
But you know what you've done for years really well with Adobe, as we're sitting there on the desk and the stock's reporting, you'll say the stock's always down. You say the stock's always down after they report, and you usually say, wait a few days, and then you buy it, and then it'll be back up. And that's worked, and maybe that works again. My point was, I didn't want to buy it down 3 or 4% given what I thought was going on. And the other point I'll just make about this company, again, here's a $200 billion market cap company that, the growth is decelerating. Their earnings growth is decelerating, expected to be 10% this year, 18% next year, which probably seems kind of high. 31 times this year, 11 times sales, just seems really expensive. And here's the other thing, Guy, I want to get your take on this. 90% gross margins. That's amazing-ish, okay? They've never been higher. Well, they can't go much higher, okay?
Yeah, that's true.
So, that's kind of my point here. I don't find this one particularly compelling. And you look at that break of that uptrend. That was beautiful. And you look how far it's come since it broke it in just a matter of months here. You tell me, where's the next level of support? Is it that 2020 high before the pandemic break?
That's exactly right, because we're now through the 2021 low that we bounced off of. If you look in the middle of this chart on the trend line, and it's interesting. You're right about valuation, and Adobe's always been expensive, but it's not like it's grossly expensive now. What this speaks of to me is maybe there's some competition out there for a company that basically had no competition for the last 5 to 8 years, and that's the way it's trading. But where's the next level? Well, probably comes in the form of sort of 380, somewhere between 380 and $400, and then you can start to look at this again. Great call by you, bad call by yours truly.
No, I mean, listen, at the end of the day, Guy, you and I have said this a lot. Every once in a while in Fast Money, I'll say it when we get really hot. We got lots of trolls. Everyone's tweeting at us and this and that or whatever. Listen, I'm not your broker. I'm not your hedge fund manager. We show up on Zoom, we go on TV, we're like the guys in Sports Center talking about the games during the day. What the hell do we know? I mean, we're just trying to kind of keep it real a little bit.
And it's interesting, and it's a good point. And what do we know? I mean, no more than anybody else. What we try to do is put, my 35 years, actually it's more like 50, and yours, and yours almost 3 decades now of experience. And we try to talk about things that we're somewhat well versed in and try to give people a roadmap. That's always been the case, but it's not like we're giving investment advice. Neither one of us are registered investment analysts or whatever they get, advisors. Yeah. But we try to help people look at these things and make educated decisions, Dan, and have a conversation.
You know what? And I hope we don't sound offensive here, but you know what? I've spent 25 years staring at Bloomberg and FactSet machines and talking about it with investment professionals, with strategists, with analysts, with investors, with people like you. You've been doing literally Fast Money since the start for 15 years. I've been doing it for 11 years. I actually really think the ability to process the information and talk about some of this stuff and explain it in a way is amazingly useful. And we meet investors all the time, whether we're podcasting with, or they come on the show, or they're practitioners in the business who really are maybe really good at what they do, but if they can't articulate it, they're missing something about it. Don't you think so?
100%. That's exactly synthesizing information, making it accessible. We play a game on CNBC's Fast Money from time to time. Would you rather? I try to play by the rules. Others don't. Dan, would you rather? This is a question from Mundian. Dan, would you rather Amazon or Google? I actually think I know the answer to this, Dan Nathan.
Yeah, I like Amazon. Listen, I don't dislike Google by any means. I'd like to see them all go down. I don't like why Amazon just shot up 15%. I mean, that's the one thing. I wish it gotten overdone, and then that catalyst was kind of lurking out there. I think the timing was bad. What about you, Guy? Amazon or Google?
I'm with you, Amazon. I didn't think Amazon would get as low as it did. Obviously, they announced that split. Whether I think it's a big deal or not, market does. They announced a buyback that was insignificant. But I think the second half of this year, I think it's going to be Amazon's half. And I've said that basically since late last year. We'll see. We got a Roku chart we want to take a look at because I just think this is one of those things. Yeah. You were on with CBW yesterday. Once again, my man Carter making bold calls. Looks like he's going to be right about this one too, Dan.
Well, here's the thing. I put this one up there because last week when I was out, you had him on and you guys were talking about the potential for Square bottoming, and it had that massive rally, over 50%. And so you look at this thing and you look at the just how horrible this decline has been over the last 6 months or so since last summer, and it picking his head up a little bit over that vicious downtrend. And I asked him, he likes it here. And so one thing I would say is, listen, I don't want to buy this thing. I mean, I think that there's a potential for another tape bomb here, but you get through that gap fill from last month, right, on earnings, and you look out to next earnings and maybe expectations are low enough. I mean, the way I would play this, I'd look at that 150 level, and the May 150 calls are like $8.50. You do the math. I know that's 6.5% of the stock price, and it doesn't break even up until 158.5, and here we are at 130. That's a long ways away. But man, if there's ever a reason for this thing to go higher with that short interest and the negative sentiment, it could be back up at 200 like that.
I like the way you snapped it. It was a good snap. You were nervous when you did it. You're like, boy, I hope it works. And you were able to pull it off. Good for you. We got a question here, Dan, from Kevin. We're in OT right now. I apologize. But listen, I mean, whatever. Yeah. This is from Kevin. What is your thought of people typically using the phrase invest for the long term when most people can't handle a 70% drawdown? I'll tell you what I think of it. It's a frickin' cop-out. You know what? I could say, for the long term, I love this stock, and there are no ramifications. I'm not going to curse here. That's what I think, Dan. You don't have to answer that. Chris Sinclair asks, Why didn't the Yankees win a World Series in the 80s? As you know, Chris, because you asked the question, Junior, the Yankees won more games than any other franchise in Major League Baseball in the decade of the 80s. For some reason, they were unable to get to the big dance and win it. I don't know why. I'll tell you this, though. I love Jack Clark in pinstripes, Dan. And that's it. That's it. Like this, we're out of here. I mean, it's time for us to go. Dan, you have anything to say? You want me just to wrap it up?
No, I think as an homage to Callista Flockhart, we should say we're Audi McBeal, buddy. It's it. It's over, right?
We don't even rehearse this stuff. I mean, I did like that show. Audi McBeal, great. She was great. She's still married to Harrison Ford, who's about...
Yeah, but you know what? I take issue with that. Harrison Ford, easily one of the best actors of this entire generation. And you look at the blockbusters that he's been involved in. But when she married him, they moved to Montana, and she stopped acting.
Listen, what can I tell you? I mean, you're married to Harrison Ford. You get in a plane, fly around, do your thing. I mean, Montana, by the way, is a beautiful country, state. And to quote The Hunt for Red October, I would have loved to have seen Montana. And maybe one day I will. Who knows? Anyway, thanks to our sponsors, FactSet and Open Exchange. We will be back tomorrow at 1 o'clock. And you know it's Thursday. And you know what's on Thursdays, Dan? We got EY from SoFi.
Liz
Yeah,
Young.
we do.
Yeah, we do. All right, buddy.
Later, people.
See ya.